Broadcast is now starting. All attendees are in listen-only mode.
Hi, I'm Lisa Roos, the Director of Long-Term Care Insurance at One Resource Group, and we want to thank you today for joining us for the webinar with Joe Taylor from Nationwide. He's going to be discussing different types of LTC riders, linked benefit policies, and their tax deductibility. Please put your questions in the chat box and we'll answer them at the end of the webinar today. And from here, I'm going to go ahead and let Joe start the webinar here for us.
Awesome. Yeah, thank you very much, Lisa. And thanks everyone for joining. As Lisa said, my name is Joe Taylor. I am the Regional Care Matters wholesaler for Nationwide in the Midwest, and I partner with BGAs like One Resource Group. And I'm really excited today to deliver today's presentation. It's a very important topic, especially now that it's tax season. So it's going to be a good opportunity to either familiarize yourself with the topic or get a refresher as you have conversations with your clients, or you can look for opportunities for next year's tax season. So there's a lot of information in this presentation today. I'm not going to be able to cover it all. So I will say, if you're interested in learning more about this, I'll send the slide deck over to Lisa to pass out, but Lisa and I are more than happy to do joint calls and kind of dig a little bit deeper into this topic and maybe look at some specific cases and how that would work for your clients. So we are going to focus today a little bit more on the tax advantages for the LTC combo and hybrid products. They offer a little bit more of those tax advantages, and we'll discuss that here. We're going to look at also how that'll apply to individuals and your business owners. There's a lot of opportunity for business owners and to offer them a long-term care solution, not only for themselves, but for their employees. But we'll touch on individuals and business owners. So go through the disclosures here. We are going to be talking about taxes. Obviously, I'm not a tax advisor. I can't give advice. So it is very important to understand that, any tax situation, please have your clients or yourself consult a tax professional. So we're going to start off by just looking at kind of the rules of LTC in general, how the structure of linked benefit policies work both with Nationwide and other options out there, and why that's important. And then we're going to go into both our individual solution as well as our new joint life option, and how those tax advantages would apply to our joint life option. What we're not going to cover is kind of that second half of this on the agenda. Again, you'll see that in the slides that I send out. So if you do want to learn a little bit more about that, again, please reach out to us. We can have a conversation about that. That talks into more of the tax forms, which your clients might be receiving now, or what they might have to fill out if they are receiving LTC benefits. So what are some general rules of thumb, or the common tax rules from an IRS guideline standpoint? So all long-term care benefits on a Section 7702 long-term care rider are going to be tax-free, as long as you're able to incur those LTC expenses. It doesn't matter if you receive more than the HIPAA per diem amount. So if you're receiving anything less than the HIPAA per diem amount, which this year, and the IRS sets this guideline every year, and it generally increases. It actually decreased this year, but if you looked over the past 5-10 years, you would notice that the general trend is up. This year, it is around $12,400 per month. So if you receive any benefits less than $12,400, those benefits are going to be tax-free. If you receive benefits or long-term care benefits above that HIPAA amount, and you're able to prove that you spent those on qualifying long-term care expenses, those are tax-free as well. So in general, the long-term care benefits that you receive from a life insurance policy with a long-term care rider, or a linked benefit or combo policy, are going to be tax-free. And just for those of you who are thinking, how often does a policy create a benefit greater than HIPAA. From a Nationwide's perspective, 95% of the policies that we are issuing are less than HIPAA. So unless there's multiple policies on the same insured, that tax question may not come up as often as you think. The taxes are responsible to be paid for by the owner as well, so keep that in mind. So let's look at a couple of examples that I was talking about there. Let's say the HIPAA per diem is $12,600 per month. Your actual LTC expenses during that month were only $8,000. You were paid a total of $10,000. All $10,000 of that is going to be tax-free. So you don't have to justify the expenses because your monthly benefit of $10,000 was less than the $12,600. That's considered tax-free from the IRS. Now let's use that same example, $12,600. Your actual expenses were $14,000. You received a monthly benefit of $15,000. $14,000 of that is going to be tax-free, and then the policy owner will be taxed on that $1,000 as ordinary income. So anything above what you actually spent on qualified long-term care expenses would be considered ordinary income. So there's a couple of examples of how the IRS would look at those tax issues if you receive more or less than the HIPAA per diem amount. As I was talking about, there could be multiple policies on one single insured. Maybe family members own one on their parents, and then the parent also has their own individual policy. So first, the insured, if the insured is also the owner of their own policy, they're going to get the first benefits of the tax advantages up to that HIPAA amount. So if there were multiple policies and the insured was not owned, was an owner of the policy, then it's going to be divided pro rata, split between any of those policy owners and how they would handle those taxes. So in that last example, if there was $1,000 of tax and there was two policies, 500 and 500 would be to each of those different policy owners. Secondly, here, you're going to notice a lot of the linked benefit or combo policies are going to be MECs, modified endowment contracts. You might run into this on a life insurance policy with a long-term care rider, depending on how you design it. But most, if not all, linked benefit policies will become a modified endowment contract. And I get this question all the time, does that affect the tax status of the benefits? And the answer is no. The long-term care benefits are still going to be tax-free. So you don't have to worry about, because my policy is a modified endowment contract, am I going to be taxed on those long-term care benefits now? A MEC is only going to cause a taxable event if you're taking out a withdrawal or a loan. So the long-term care benefits are an acceleration of the death benefit, so they're still going to fall under that tax-free status. So how do these long-term care policies create these tax advantages? Well, it's due to the structure of the policy and whether or not the long-term care rider cost of insurance comes out of the cash value or not. So in most instances with the long-term care policy, and this is true from a life insurance with a long-term care rider, the cost of insurance is coming out of the cash value. So it's not going to be deductible, and you're not going to be able to get those tax advantages from a tax deductible standpoint here, which we'll talk about how individuals and business owners can get those tax deductions. However, with some linked benefit policies, and both of Nationwide's Care Matters 2, our individual solution, and our joint Care Matters Together option, they have separately identifiable premiums. So we separate the life insurance from the long-term care premiums, and we deduct the life insurance from the cash value, but we do not deduct the long-term care riders from the cash value. So this gives us that qualified long-term care tax status, and they're able to be tax deductible. So if you had to create a hierarchy of what's the most valuable or what creates the most opportunity for those tax advantages, who's going to get the most tax deductions, and you looked at it from left to right, your biggest opportunity, your most valuable tax deduction is going to be your C Corp business owners and any business entity that purchases a linked benefit policy for an employee. They're going to be able to deduct 100% of the premium as a business expense. Next would be your pass-through entities. That's going to be treated as self-employment health insurance, and they're going to be able to get an above the line deduction, which is a little bit better than the individual options that we have here. And they're able to deduct up to their age-based limits, which will show you what the age-based limits are. But it's still a good opportunity for those pass-through entities who want to purchase long-term care on themselves or maybe a spouse. Next, we've got our individual tax deductions. The LTC premium is going to be deductible up to their age-based limit. However, they're subject to the 7.5% floor. So their adjusted gross income, they've have to have medical expenses of 7.5% in order to qualify for that deduction. So while it could happen, it may not happen immediately or in each year while you're paying those premiums, so you may not be able to get that deductible, but it'll still offer that potential tax deduction for individuals. Lastly, if you have clients or you have access to a health savings account, you're able to use your health savings account, take a qualified distribution from that to pay up to your age-based limits in long-term care premiums. From all of these here have unique differences in the potential tax deductions, and the design of the policy is really important there. So if taxes are something that's maybe driving the sale, or they want to take advantage of the tax deductions, you're going to want to pay attention to design. So, leverage Lisa to help create the best design for that specific situation. Okay, so let's look at a couple of examples here from an individual perspective. You've got the federal tax deduction, again, for an individual who, let's say they have a $100,000 AGI, they would have to have $7,500 in out-of-pocket expenses in order to get that tax deduction. So the long-term care premium itself does actually help get to that required floor, but you would have to meet that 7.5% floor in that year in order to get the deduction. And again, those are based off of the age-based limits, which I'll show you what those are in a second. Now, the advantage for the HSA is you don't have to meet that 7.5% floor, and you don't have to itemize on your tax when you're filing your taxes. This is just going to be a distribution from your HSA up to your age-based limits. And you can do that at any point in time. You don't have to do that immediately. I'll talk about it later here about saving your receipts, and we all know that the health savings account has those triple tax advantages. So if you can pay out of pocket, do that, save your receipt, keep your investments in that health savings account growing, and look at taking a distribution later in life. You're not gonna be able to choose both of these in the same year, so you're gonna have to choose the best option for you in that particular year. So here are the age-based limits. So this is going to be true for, again, those pass-through entities and your individuals. They are the same chart. We've got 2018 to 2023 here. I do have the 2024 numbers, which I'll give you here in a second. But like I said, this is similar to the HIPAA per diem amount. They generally do increase. You can see in 2022, we in this 61 to 70 range, we decreased by $10, and in 2024 we did have a few reductions in the age-based limits. So real quickly here, from 40 and younger, the 2024 limit is $470. From 41 to 50, it's $880. From 51 to 60, your age-based limit's $1,760. From 61 to 70, the age-based limit is $4,710. And then 71 plus, it dropped from $5,800. It dropped to $5,880. So if you were 61 years old and you paid your long-term care premium in 2023, you could get that deduction of $4,770 or take that qualified distribution from your HSA. In 2024, you would need to take the $4,710 distribution or deduction. So each year it changes. You'll be able to take up to the max of your age-based limit or your long-term care premiums. Okay, let's look at how the policy would be structured if a C Corp or any business entity was purchasing a policy for their employees. So the business is only going to be the payer. They don't own the policy, they're just the payer, and that's how they're going to qualify or get those tax deductions. The employee is going to be the policy owner and the insured. So again, we separate the life insurance from the long-term care premiums. So the life insurance premium is going to be treated as compensation or a bonus to that employee. So that is 100% tax deductible to the business as a business expense. The employee, they're going to have to pay taxes on that as compensation received. So they'll pay taxes on the life insurance portion of the policy. The long-term care premiums for both the business and the employee are tax deductible. And therefore, from the employee's perspective, it's going to be completely excluded from their income. So that's really the advantage that the employee gets if the business is able to purchase it for them. You know, they're only paying taxes or getting that bonus, if you will, for the life insurance portion of the policy. So we see this a lot for, you know, executive benefit plans or doing an executive carve out for your key employees and having the business pay for it. They'll get 100% of the deduction and the employee's only paying, you know, a small portion of that, or having to pay taxes on a small portion of that. And again, we can design these to maximize the tax advantages for both the business and the employee. Other things to keep in mind too, we can include spouses and dependents. So you can include spouses on our individual solution, but we can also, you know, add a spouse to our joint life options out there. So the C Corp, they're going to have the best tax advantages because they're going to get to deduct 100% of the premium. If we're looking at a pass-through entity, they don't have to worry about that 7.5% floor because they're going to get an above the line deduction. So they, again, have to follow those same parameters with the deduction is subject to the age-based limits, and they can also include spouses as well. So real quick, just an example, you know, let's say your total long-term care premiums on the policy are, let's say $1,500 and you're 55 years old. So your maximum age-based limits, we'll use 2023 numbers because it's on the screen, is $1,790. The maximum deduction you're going to be able to get as a S Corp or a self-employed individual is going to be that $1,500. So you're not going to be able to get a deduction more than what your long-term care premiums are. Okay, so how would this work in a joint life situation? First of all, why would you consider a joint life policy? Well, they're designed to be more cost effective or more affordable because we're insuring 2 lives. We don't have to pay out a death benefit when the first person passes away. So it's going to be less expensive than 2 individual policies. It also helps eliminate the kind of the guesswork, you know, who's going to go on claim when, how long are they going to go on claim? Let's just create one big pool of long-term care that both of us can access whenever we go on claim. So it creates a more affordable option than considering two individual solutions there. So the policy, if you're looking at joint life, there are joint life options out there that wouldn't have these tax statuses, so they do need to have that separately identifiable premium. Like we mentioned, Care Matters Together will have that separately identifiable premium, so you'll be able to take advantage of these tax advantages. Okay, from an individual perspective, how would this work if you're filing joint? So if you're filing joint, then the 7.5% floor can be combined for household expenses, medical expenses, and that also includes the children. So you might be able to meet that floor if you're a family and own one of these policies. If you're filing separate returns, then that's going to be totally separated. Each of them will have to meet it on their own, that 7.5% floor, and they're not going to be able to take advantage of combining their assets there or their income. The LTC age-based limits would apply here from an individual basis. So if you've got an age gap in there, the deduction might not be the same for each individual. So you'll want to keep that in mind. And then if you're not married, it's going to be that same kind of status as each having to apply or meet their own 7.5% floor. But if you're doing the joint life policy, then it's not going to be deductible, or the life insurance is not going to be deductible. It's going to be only those LTC premiums up to your age-based limits like we showed in the charts before. So the joint life just can still take advantage of all of the individual or using an HSA perspective. It'll just depend on how you're filing your taxes. So we've talked about the HSA. Let me spend a little bit of time here to just talk about the shoeboxing method. So if you haven't heard of the phrase or the term shoeboxing, what that means is, again, if you can have access to a health savings account and you're able to pay out of pocket and save that receipt, and then put it in a shoebox, save it for later. Let the health savings account continue to grow, and then some point later on in retirement or later on in life, you can still take a deduction, or you can still get reimbursed from your health savings account later on in life. It doesn't have to be in that same year that you paid your premium. So it's a good way to kind of let people keep their health savings account continuing to grow, take advantage of those triple tax advantages. The joint life policies will still work in the business setting, and I think it'll make it more advantageous, or employees open to including their spouses on the policy in a nice way for that business to help retain their key employees by letting them pay for the spouse's long-term care policy. So the same rules are going to apply for those executive carve-outs or the C Corp owners, and being able to include the spouse. The life insurance portion of their spouse would be included in the employee's income, and they would pay ordinary income on both insured's life insurance portion of the policy. So to summarize things, and then we'll open it up for questions and comments. The LTC benefits are going to be tax-free to the greater of the HIPAA per diem amount or your actual long-term care expenses occurred. So we looked at an example where the age-based limit was $1,790, but your LTC expenses were only $1,500. The deduction you're going to be able to get for an individual is only going to be $1,500. What you want to pay attention to, or different types of policies that get access to these tax advantages are most likely going to be your linked benefit policies. And why is that? Because they have separately identifiable premiums. So we separate the life insurance portion of the policy from the long-term care policies. The life insurance premium or cost of insurance comes out of the cash value. The long-term care riders do not. So business owners are going to have more opportunities to get different tax deductions. Those types of policies can really turn into multiple cases. So if you're working with the business owner, they're looking to maybe buy long-term care for themselves. They learn about these tax deductions. You let them know that they can offer them to their employees, their key employees in an executive carve-out situation. These really can turn into 2, 3, 4, and more types of cases. And we didn't touch on those last two, but again, we'll send out the full slide deck so that way you can learn more about the rules that were 1035s and some of the tax forms that people will be receiving if they own a long-term care policy, or tax forms that they might need to fill out once they're receiving long-term care benefits. So I'll end with that, Lisa, and open it up to see if anyone has any questions. Or Lisa, if you've had any questions and I can help answer,
Yeah.
happy to do that.
Yeah, thank you, Joe. We do actually have some questions here. One of the first ones that somebody asked is, Nationwide the leading carrier for all or most life and annuity LTC benefits? Do you know where you guys rank on that?
So from a linked benefits perspective, Nationwide was number 2 in the linked benefit space last year. And I know that since we launched the joint life option, which was just back in June of last year, we've actually had a record number of applications come in, especially at the beginning of this year. And we're really not seeing that slow down. So we're really happy with the launch of Care Matters Together. And we still have very competitive solutions and options with our individual options as well. And I think there's great reasons to consider both an individual and a joint option. So it does make us a leader in the industry to help you, the advisor, have better planning conversations with your clients and kind of figure out what's more important to them. And then we can help figure out the best solution for them, whether that's a linked benefit policy or, our long-term care riders on our life insurance solutions.
Awesome. And you said you were going to email a copy of this presentation out to me for me to provide to everybody, correct?
Yeah, I'll have that, and then we've got a really great white paper that summarizes everything as well.
Okay. And then, do you happen to know how long it takes to put one of these place one of these policies in force? What the average processing time would be?
That's a great question. So from the time it takes to do the application, complete the underwriting, we are now on a 3 to 5 business day underwriting review. And with these linked benefit style policies, it's pass or fail. So if your clients complete the digital interview, so we send you a link, they complete the part 2 of the application, the health questionnaire or the interview that used to be done over the phone. If they complete it immediately or after they submit the application, we can have an offer out within a week. And then the last step is just to collect premium. So to answer the question, we can get these issued in 1 to 2 weeks. It just, a lot of it is in the hands of the client and how quickly they complete the underwriting. And then, of course, you add 1035s or with 2 insureds on the policy, if they don't complete it at the same time, could extend that time. But we're in our normal SLAs in terms of underwriting offers, and we're getting policies in and out the door as quickly as we can.
Awesome. So one of the things that, with the joint product, the Together, Care Matters Together, we want to make sure we're pre-screening those cases before we submit them because, of the, one of them has to at least be at preferred rating, correct? So we want to make sure, and they could be table rated, the secondary person, correct?
Yeah, so the joint option Care Matters Together, it does have 2 risk classes, preferred and standard. So it is really imperative to use the pre-screening process. And I highly recommend doing that for every case, whether you think they're the healthiest person, you've known them your whole life, just little things can slip through the cracks. And we just want to make sure we can get the best solution for you. So as Lisa was mentioning, one person has to at least be preferred. And we are able to add a little bit of additional risk on that second insured if they're a standard risk class. And our pre-screen process and will help you identify, what they would potentially qualify at and give you more options, whether you want to stick with the joint option because you've got one person that's in standard, or maybe one person just wouldn't qualify right now, then you can pivot to the individual option. So definitely recommend doing the pre-screen.
Right. And that's something that I, help take care of for the advisors. If you've got a client that has, certain conditions or anything like that, like Joe said, pre-screen and send the information over to me, and that's something I'll get sent into the carrier. And you guys are available in all the states, right? We don't have any restrictions on that.
So Care Matters 2 is available in every state except for New York and Montana. Care Matters Together is available everywhere except for New York, Montana, and California.
Okay. Let's see. Somebody's got a question here. On flexible premium annuity, is it possible to separate the premium for the critical care rider in order to receive the tax advantage?
From an annuity perspective, I am not familiar with that, but I can look into that, Lisa, to get some more clarification on that, to see if the annuity version, and if we're specifying critical care, my initial thought is no, because it's not going to get the same status as a true long-term care rider, but
Right.
I need to clarify that.
Right. And then let's see here. If a business owner already has an individual policy, what can they do to make it tax deductible to the business? So basically, it sounds to me like it's an already enforced policy. Would they be able to make that tax deductible to the business at this point?
The business would just need to be the payer. So, it's not like we're transferring ownership or anything. So if the business becomes the payer, then depending on the tax status of the business, they would fall under that, those different tax opportunities or tax deductions.
Okay. Looks like we had somebody that had just placed a Care Matters policy on a client. He had, paid with a single premium. He might, would he be eligible typically for a tax deduction resulting from the premium payment? Because it'll break it down. So whatever part of it that is the LTC, would that be deductible potentially?
Is it from an individual perspective or a business owner?
It doesn't specify. I'm thinking maybe it's an individual, or even if maybe if it was. Can we answer for both? That's what I'm trying to say.
Let's answer for both. So, if it's an individual and they did the single premium and the long-term care portion of the premium met the 7.5% floor of their adjusted gross income, then they would qualify for the deduction up to their age-based limit. So it really depends on how old they are, how much of a tax deduction they would get, or how much they're making, in order to potentially meet that requirement. But if someone who was 62 years old, I think that the age-based limit was around $4,500. So if they met that from an individual perspective, their 7.5% floor, they could potentially get that $4,500 tax deduction. If they have access to an HSA, they can definitely get a distribution from their HSA, but they would only be able to do that once, and it would only be able to be in the year that they paid the premium. So if they bought it in 2023, they could get that for 2023 tax year. If they just bought it this year, then they would be able to do that when they file it next year. From a business standpoint, kind of the same rules would apply. The business would have had to have paid for it in order to meet those requirements in order to get the deduction. So it would just depend on who paid for it. But again, that's where we're, Lisa and I can help out with, if the tax advantages are important in the sale, or they want to maximize the tax deductions. I think about it for somebody who has access to a HSA, looking at one of our extended payment durations, like say someone in their late 40s, early 50s, instead of doing a 10 pay, maybe look at our pay to age 65 or our 20 pay on the Care Matters Together option. That way they can pay premiums into their 60s and then take advantage of those higher age-based limits. So something to think about there from an individual person's perspective. From a business owner's perspective, we can design it to where the life insurance portion this is from a C Corp or a business entity purchasing it, we can design it so the life insurance portion of the policy is the least expensive or is as low as possible, and the long-term care portion of the policy is, has the most part of the premium. That way for the employee, they're not including that in their income, and then from the business perspective, they're still deducting 100% of the premium. So we can try to maximize that from both parties' perspective.
Okay. Two more questions, and I believe you answered this. The joint product is not available in California, correct? It's just the Care Matters 2 product?
Unfortunately, it's not. We've filed it, and if you do work in California, you probably know that California is sometimes slower to approve newer products. They have a long review process. So we have definitely filed it, and we are eager to get it approved. I'll give you, in some cases, I've had success if your client who lives in California has property outside of the state of California in a state that is where Care Matters Together is approved. You could do what's called a non-resident sale, and they could purchase a policy outside of their resident state. So they have to meet certain requirements to do that. The most common one I've seen is just owning another property. Let's say California, they have a house, in Nevada or something. They would be able to purchase Care Matters Together there.
So that, with that being said, they wouldn't have to be like you said, they could be in California, or say they're somebody that lives in New York and has a property in Pennsylvania and wants to write a product that would not be available in New York. It's okay to do that with a non-resident form?
Yeah.
Okay.
And that's where it's most common, New York and California, where we see those opportunities present themselves. Now, what's important to know is that you have to sign the application in that state that you're purchasing the policy in. So you can't just, sign the app in California and the Pennsylvania app while you're in New York.
Right. Let's see here. Now, you guys have an advance, or, you guys would be able to help somebody if they were, needing assistance in trying to close the sale with, like, say, a business owner. Is that something you could do, like a webinar online or anything like that? Do you have that ability, or do you have an advanced marketing team that helps out with that?
Yeah, I'm able to join client calls and happy to discuss that, whether it's just from a high level perspective or a case by case situation. And when we generally would bring in our advanced sales team, might be for that business owner and how we would kind of implement it. Generally, we would like to try to get the HR department involved too, because they're the ones typically handling
Payroll
like the
and stuff.
pay and the payroll and
Yeah.
and the benefits itself. So if we can get them involved and the business owner, I think that creates a great conversation and lets them really understand how it's all structured and how it's going to flow and work. But from a case-by-case situation, just talking about how it would work, I'm happy to join and capable of joining those client calls.
Yeah. Last question. One, I like the shoebox method. That's a good idea on, putting that money from the HSA away. You mentioned that you can pay for the premiums for the LTC. Does that include the life and the LTC, or is it just LTC premium that can be taken out of the HSA?
That's just the long-term care portion. So the life insurance portion would not be available. It would just follow those same age-based limits rules and the greater of your LTC premium or your age-based limit.
Okay. Well, thank you everyone for joining us today to discuss Nationwide's tax deductibility of LTC riders and linked benefit policies. Joe, wanted to thank you again for taking the time to discuss Nationwide's products with us and kind of go over all this good tax information. This is real useful, especially, being tax time. Let's see, it looks like somebody's got one final question about carve-outs available for C Corps. Do you want to answer that real quick?
Yeah, just in general, that's a great opportunity. Those would absolutely work, and they would get the C Corp would be able to deduct 100% of the premium.
Okay.
And then the life insurance portion would be treated as a bonus for the employee, so they would pay taxes on that, and the life insurance portion would be excluded from their income. But yeah, I'm happy to discuss that and see how we can implement that, or how the taxes would work there.
Okay, awesome. And just keep in mind, I'll be sending out, Joe's information from the webinar and the white paper, as well as, tax guides from Nationwide after this webinar today. Please remember to check out our LinkedIn showcase page. We put useful information for the LTC department out there for you. And once again, I am Lisa Roos, the Director of Long-Term Care Insurance here at One Resource Group. It's been a pleasure having this webinar today with you guys, and I look forward to working with you. Thank you.
Thanks, Lisa. Thanks, everyone.